Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. May 12, 2026 Market Update. Semiconductor drop, retail options extreme, and macro data. This video presents a direct informational narration of the source document. Okay, we've got a lot of ground to cover in this explainer today. From a significant drop in semiconductors and a historic retail options frenzy to some very sticky macro data affecting treasury yields across the board. Let's get right into it.
Here is our roadmap. We will be sequentially reviewing sector performance, geopolitical updates, April CPI and yields, the K-shaped consumer, the ongoing gamma squeeze, and finally, key technical levels.
Starting off with Section 1, Sector Performance and Market Divergence. We saw some clear divergence in the major indices, with the Nasdaq and Russell leading the declines. But the real story is the undeniable sector rotation within the S&P 500. There was clear outperformance in defensive areas like healthcare and consumer staples, while technology, consumer discretionary, and high-momentum AI stocks noticeably lagged. To put that tech drop into perspective, the Philadelphia Semiconductor Index fell nearly 7% intraday before closing down 3%. That marks its largest single-day drop since late March. In fact, 29 of the 30 semiconductor components closed in the red, with NVIDIA being the sole exception to manage a gain.
Now, looking at the semiconductor space from a diplomatic angle, there's an upcoming U.S. business delegation visit to China. The confirmed list features 16 U.S. business leaders. What's particularly interesting here is that NVIDIA's CEO, Jensen Huang, is not included on this list, whereas executives from both Micron and Qualcomm are officially confirmed to attend.
Moving on to Section 2, Geopolitical Updates, specifically Middle East tensions.
Markets are currently awaiting the conclusion of upcoming diplomatic visits to see if there are any new developments regarding Iran's stance. As it stands, Iran has reiterated 5 strict conditions for returning to the negotiating table. Those are ending the war, lifting sanctions, unfreezing funds, providing compensation, and recognizing Iranian sovereignty over the Strait of Hormuz. Alongside these conditions, Iran's parliament speaker issued a pretty stark warning that any further attacks could prompt them to enrich uranium up to 90%.
That brings us to Section 3, April CPI data and yields.
The April CPI report came in hotter than expected across several metrics, which is definitely intensifying concerns about lingering price pressures. Headline CPI rose 0.6% month-over-month, which met expectations, with energy accounting for over 40% of that rise. Headline year-over-year hit 3.8%, beating the 3.7% expectation. Core month-over-month came in at 0.4%, and core year-over-year hit 2.8%, both beating expectations. But perhaps the most persistent issue noted in the data is in services. Core services inflation rose 0.5% for the month, and supercore services showed persistent acceleration, hitting 3.4% year-over-year. This data potentially delays any return to accommodative monetary policy.
Because of this persistent inflation data, the bond market is making significant moves. The 30-year U.S. Treasury yield just breached the critical 5.0% threshold. At the same time, the 10-year yield is climbing toward 4.5%. So what does this tell us? It signals that the market is actively pricing in long-term inflation risks.
Given these sticky inflation levels, there's some growing speculation regarding the Federal Reserve's policy framework. The thought is that the incoming Fed leadership might actually modify the strict 2% inflation target. Doing so would theoretically allow the Fed to regain some flexibility for future interest rate cuts, even if inflation doesn't perfectly cool down to that 2% mark.
Next up, Section 4, the K-shaped consumer.
April data from Bank of America reveals a stark K-shaped economic reality, highlighting highly uneven performance across income brackets. For high-income households, wages grew by 6% year-over-year, and the top 5% actually saw 10% growth. This fueled a 4.9% increase in their spending, with noticeable upticks in discretionary categories like travel, dining, and apparel. On the flip side, middle-income wages grew 2.3%, and low-income wages grew just 1.5%. For both of those groups, discretionary spending actually decreased, with the low-income bracket seeing the sharpest pullback.
To put this disparity into perspective, just look at the impact of gasoline price shocks. For high-income households, their wage growth is roughly 17 times the increase in gas prices, making the impact almost negligible. But for low-income households, their 1.5% wage growth barely offsets the rising costs at the pump, absorbing almost all of their income gains.
Despite these consumer divergences, the broader market seems to be trading on two incredibly perfect assumptions right now. Assumption one is that tensions in the Strait of Hormuz will not cause a spike in oil prices and that oil will actually fall. Assumption two is that the massive AI capital expenditures by large tech companies will perfectly monetize to drive rapid earnings growth by 2027. The market is currently pricing in a scenario where both of these macro and fundamental factors play out flawlessly.
Now let's look at what's happening under the hood in Section 5, Gamma Squeeze and the Retail Options Frenzy. Beyond those perfect macroeconomic assumptions, a major driver of the market's rally over the past month has been extreme retail speculation. We are seeing a continuous options gamma squeeze that is completely detached from underlying fundamentals. Right now, a staggering 52% of all retail opening trades in mega-cap tech stocks are call options. This represents the absolute highest level of speculative activity recorded since the meme stock era of November 2021. When you compare current options metrics to that November 2021 extreme, today's numbers actually far surpass it. Positive gamma is now exceeding $21 billion, compared to roughly $15 billion back then. The one-month correlation is plummeted to below 3%, and actual stock dispersion has jumped over 64%. This data shows individual stocks are being pushed around drastically by these options mechanics rather than broad economic factors. If we look at the historical pattern from that post-November 2021 extreme, the market didn't peak immediately. It actually continued to rally for another 4 to 6 weeks. However, right after that window, a 10-month bear market began. While history is just a guide, it clearly illustrates that this extreme level of speculation is ultimately unsustainable.
Finally, we have Section 6, Key Technical Levels. Following the recent market drop, let's map out the critical support levels, starting with Qualcomm. Qualcomm actually led the semiconductor decline, falling 11%. With relatively slow EPS growth projections over the next few years, its immediate minor support sits in the 205 to 209 range. If that breaks, the medium support is between 190 and 202, and strong support is down at 178 to 183.
Looking at the broader semiconductor indices, the SOXX ETF absolutely must hold the 489 to 507 range to keep its upward squeeze intact. If it fails there, medium support is 450 to 467, with strong support way down below 368. The SMH faces a similar critical threshold, needing to hold between 533 and 552 to maintain momentum, with medium support below that at 499 to 511.
Shifting to the broader indices, the S&P 500 has its immediate minor support at the 728 to 735 gap, with medium support at 707 to 716 and deep structural support at 695 to 676. For the Nasdaq, the immediate trendline break level is sitting at 688. If that level is lost, it opens the door to medium support at 645 to 665, with deeper support stretching down to the 588 to 613 range.
As we look ahead, the critical question for the market is this. Will the impending U.S. diplomatic and business visit to China result in substantive signed agreements for the technology sector, or will an empty-handed return shatter those perfect market expectations and introduce immediate bearish pressure? We will certainly be watching these developments closely. Thank you for joining us for this explainer of the source document.